Money is a scam, and no chart shows this better than this one over here. Our system is a complete lie. The issue is that good lies still have parts of truth in them. That's why they're so hard to discover. The partial truth that people still tell us is that yes, there is inflation. Yes, our money does debase over time. But the degree to how much is debased is completely lied. And because of that lie, money transfers over the long term from the people that don't have anything, that have to sell their time, to the people that already accumulated a lot of capital. Now what we're seeing over here, this is the US money supply. It's USM2. It's the official numbers of how many dollars are actually floating around. And it seems like this chart tends to go up over time with a bit of a hiccup recently. But when we look at this on a logarithmic scale, so now the percentage changes are constant over time, not the dollar changes, then this recent hiccup pretty much goes away. Now, how fast does this increase over time? Let's measure it. We've got an increase of 7,643% since 1959. So that's a 77.4x over the course of 66 years. Annualized, that's an expansion of 6.8%. Now, officially, the inflation rates are of course much lower than 6.8%. The average inflation rate over the last 110 years was 3.4%, not 6.8. So where does this mismatch come from? Is it just because the basket that's used for the consumer price index is getting moved around? What's actually the cause? Fundamentally, what's going on is that we do become more productive over time, right? We've got technological progress. Thus, if the monetary base was to be completely stable, if we weren't going to print more and more over time, then prices should actually be declining, right? It becomes easier and easier to produce that TV, to produce that loaf of bread. But because the monetary base is expanding by 6.8% per year, which is faster than the technological progress, that's why we measure inflation rate. That's why consumer prices go up by 3.3% per year. It's simply faster expansion of the base versus our productivity improvements. Now, intuitively, we all already knew this, right? The vast majority of people is struggling more and more over time, but there is a minority that is making money from this. And so if we have the right knowledge, we can take advantage of that system. The system does not exist for no reason, right? It exists because there are beneficiaries. Now, when the monetary base is expanding by 6.8%, then this is eerily similar to the expected returns of the S&P 500. So let's actually compare this. Let's have a look at the S&P 500 price over time relative to monetary expansion. So let's say there was no monetary expansion. How does the S&P 500 actually perform? So here's the S&P 500 just in US dollars on linear and here on a logarithmic scale. So it's continuously going up just like the monetary base. But here's the S&P 500 relative to the monetary base. This is a long-term chart. It starts in 1959. It tells us that if we do invest at the wrong time, we can lose quite a bit of purchasing power. So that's 73% over here. And if we want to get our money back, it can take a long time. This is 37 years, the point over here to the point over here. Now, this chart also tells us a story that maybe we do make some money with stocks long term. Maybe not a lot, but there has still been positive performance, plus 44% over the course of 65 or 66 years. Now, there are several counter arguments here. The first argument is taxes, right? When we do make money on stocks, we might have to pay taxes. The second argument is fees, right? We might have to pay management fees if we invest via a fund. But then, of course, there's also dividends on top of this. So if we assume that the dividends and the management fees, they all cancel each other out because we don't have the lowest cost fees ever and we don't have 0% taxes, then this might actually be the real return we get. But again, let's look at those 44% over the time. The chart starts in 1959. The historical price to earnings ratio of stocks in 1959 was 17.7. Since then, the PE ratio more than doubled. If you work with the model that stocks over the very long term should have a constant price to earnings ratio, because in the end, that's what we are buying with stocks, right? We buy the future earnings by buying the stock today. If we think that long-term prices shouldn't be completely out of whack, they should be somewhat balanced, than the doubling that we have seen in the price to earnings ratio over that time. That this is more than overcompensating for this performance, right? We would actually assume the S&P 500 to outperform monetary expansion by 100% when at the same time the PE ratio is doubling. It's not what we saw. So probably in real terms, we even saw the purchasing power of the S&P 500 going down. If the PE ratios normalize again and they go to 17, maybe even lower, then this will be even in the negative return. Now, what do we do with all of this knowledge, right? All that I currently did in this video was complain about the situation, right? The elites are against us. Investing doesn't really help us to get ahead because monetary debasement is faster than what we can do with the S&P 500. How can we actually beat the system? Here's the first option. It's taking on more risk. It's buying technology stocks instead of the S&P 500. This is the Nasdaq 100 relative to the S&P 500. And it's a chart that starts in 1985. And over those 40 years, technology stocks outperformed regular stocks by more than 400%. This, by the way, here is the dot-com boom and subsequent crash. Here's the Nasdaq 100 relative to monetary expansion. And again, we do see long-term outperformance. So taking on more risk can pay off itself long term. But then there's even another level to this, right? This is the Bitcoin strategy channel. So of course we have to talk about Bitcoin, and Bitcoin did outperform the Nasdaq 100 long term as well. So the S&P 500 can keep pace with monetary expansion somewhat. It might slightly underperform if valuations normalize long term, but technology stocks definitely outperform monetary expansion. But then Bitcoin outperforms technology stocks even more. Now the outperformance is declining somewhat over time, but still with each crash, the lows tend to go higher and higher. And then of course we don't know what the current bull run will bring, how much higher we can go. Now, most of us have probably heard about the idea that Bitcoin fixes this, that Bitcoin is an inflation hedge, but of course there is a lot of volatility. The price can crash and then recover again. If we are long-term believers in Bitcoin, then of course every crash is an opportunity. Now, on the one hand, we've got our scam system, right? We've got the fiat system where the US money supply expands by 6.8% per year. Now, Bitcoin also expands, and that is shown in this chart. This is the Bitcoin inflation rate over time. So this goes to the miners, the companies that secure the blockchain, that convert energy into Bitcoin. And the miner reward gets cut in half every 4 years. And currently they get a bit over 0.8% per annum. So this is how much the Bitcoin supply is currently expanding. Not by 6.8%, but by only 1/8 of that. And it will go down another 50% in the year 2028. Here is the Bitcoin supply over time. And here is the Bitcoin supply over time relative to monetary expansion. So yes, at the beginning, Bitcoin was more inflationary. When Bitcoin was just worth a few cents, the supply more than doubled every year. But things have shifted since then. Bitcoin's supply is now expanding much slower than the supply of the fiat system. Now, most of us invest in Bitcoin not just to keep our purchasing power, because we've got all of that volatility, right? The volatility of Bitcoin is much larger than of the S&P 500. We invest into Bitcoin in order to gain purchasing power. Is that a realistic assumption long term? I think the answer is yes, because Bitcoin, first of all, gets lost over time, or it gets locked up for a very, very long period of time. What you see over here is the Bitcoin hodl waves. So this is the Bitcoin that has not moved in the last 5 years. And this tends to go up over time. Very rarely do we see Bitcoin getting reactivated again after 5 years. Now let's take here this beginning of the sidewards trend. Let's work with this growth rate since 2019. So in the last 6 years, the Bitcoin that didn't move increased from roughly 21% to 30%. So we've got 9 percentage points over the course of 6 years. 1.5% of Bitcoin supply gets lost every year. On top of that, we've got accumulation by the ETF and by the Bitcoin treasury companies like MicroStrategy. This tended to be a very slow trend, but in the last 1.5 years, this accelerated massively. We are now at a purchase rate of roughly 1 million Bitcoin every year. 1 million Bitcoin, that's 5% of the supply roughly. So we are at 1.5% that's getting lost. We are at 5% that gets bought up by Wall Street and by the treasury companies. That's 6.5%. So we've got a system where on the one hand, we've got a fiat currency that debases by 6.8% per year. And then we've got another system where the liquid supply is shrinking by 6.5% per year. So it's working in exact opposite direction. If you have your money just in plain cash under the sofa, you are getting robbed by 6.8% per year. If you have your money in Bitcoin over the years and over the decades, you are gaining pretty much the same amount. And this is all just with the current numbers. It seems like the adoption is accelerating. Again, as we see in this chart, who knows what happens in 1 or 2 years? Maybe it's not just 1 million that gets scooped up in 2026 and 2027. Maybe it's going to be 2 million in a single year or 3 million in a single year. What this then means, so since the monetary base is going up by 6.8%, imagine your real purchasing power is suddenly going up to that degree. Suddenly, over the course of 2 generations, $1,000 of purchasing power turns into $50,000 of purchasing power. What's really going on with the purchasing power of the US dollar is the exact inverse of the supply, right? The US dollar is losing constantly. And yes, buying stocks can protect against this to a degree. Buying technology stocks is even better, but buying Bitcoin, I believe, is the best. Again, because of fundamental reasons. The liquid supply isn't expanding, it's rather shrinking. Because while the miners do get some reward, there's much more Bitcoin that gets lost or that gets bought up by Wall Street and by the treasury companies with an increasing velocity and very constantly, right? There is very few periods where we actually see this balance going down. Most of the time this is going up, and this gives us long-term tailwind. Now, the vast majority of people in crypto approach the market in the wrong way. Most people try to find those multiple X returns. They try to find the few assets that make outsized win. But this is clearly a game against the odds. Most altcoins tend to go down massively. A 70% decline over here, another 80% over here. It's all double-digit losses. Now, the common counter argument is that maybe we don't just buy 1 or 2 altcoins, maybe we buy multiple and then we might get that high flyer as well. But the problem is that diversification, so spreading the risk across various assets, does not work with altcoins. Everybody can launch an altcoin. Everybody can increase the supply as they want. And so in aggregate, the altcoins tend to do worse compared to Bitcoin and Ethereum over the long term. What we've got over here is the others dominance. So how much of all of crypto is in the altcoins that are not in the top 10? And 3.5 years ago, this was still at 19%. Now it's below 8%. So had you invested in a broadly diversified basket of altcoins, you would have on average underperformed the market by 60%. Instead of trying to find the needle in the haystack and most likely lose, at least in the long term, isn't it better to try to get the odds in our favor? If most things don't perform that well compared to Bitcoin and Ethereum, if a lot of altcoins inflate in supply over time, so supply grows faster than the demand, then why don't we bet on relative valuations? It's a bit more complex of a game, but I believe that this added complexity does help. We want to make our investing as simple as possible, but not simpler than that. And so here I am doing something differently to most other YouTubers. Most crypto YouTubers, they just show one single win. They say, here, I made some money over there. Just trust me, bro. Very few are willing to share their trading history. Now, here's my trading history on Hyperliquid. This is where I started trading decentralized perpetual futures. This is the profit and loss. And the maximum drawdown was only 5.1%. Now, obviously, I'm not going to share my positions open here on YouTube. That's part of the premium membership. It's down below. It's thebitcoinstrader.com. Now, the issue with trying to pick the winners is, of course, that we have a very low chance of succeeding. But the beauty of crypto is that it's still an incredibly inefficient market. People always say that capital markets are efficient, but in the end, it's the people that make it efficient. So if you know more than the average market participant, if you do more research than most people, if you're part of a group of people that do more research than the average market participant, then we can win. Then we are the people that make the market efficient, then we are the ones that make the profit. For example, this here. This is pure inefficiency. This chart shows the balancer token relative to Ethereum. A very constant underperformance. And we can make money from that underperformance. As the price is going down, we are printing money. Yes, we are betting on falling prices. And yes, this might be a bit more scary at first if you don't know what you're doing, if you haven't yet learned about this whole topic. But the risk is every now and then a potential short-term pump, again, when we bet on falling prices. But the reward is a very long-term constant trend. We can also turn this chart around. So this is now Ethereum relative to balancer. So we're basically buying this when we long one asset and short the other. So the inefficiencies are not necessarily that obvious in the macro, as in the market is expanding and contracting in a way that's not that predictable. But the relative valuations are much more predictable. The risk to reward in a chart like this is quite obvious, isn't it? People make all kinds of mistakes. People, for example, also just leave their stable coins in their wallet. Right? Let's say you trade actively, you've got some stable coins, and you don't use this for anything to add some additional return. That's also a mistake. For example, here we can get 15% APR by providing liquidity to Hyperliquid, the largest decentralized perpetual futures exchange. It's comparatively safe. It's definitely worth the risk for 15% APY. And so this is then the feedback that I get in the chats. It was the first nice trade. Thanks, Gerhard. And over here, a few more positive trades, etc. And people make their money back very quickly. Premium has already paid for itself. And yes, if you've only got a few $100s in crypto, this is probably not worth it. But if you're investing several thousands of dollars and you're still inefficient in your trading, if you still hope for your one altcoin to outperform, it probably makes sense to learn a bit more. And this is what I mean by learning. I've published more than 100 tutorial videos on various topics within crypto, on how to use relative valuation bets, on how to manage risk, on how to do on-chain analytics. Feel free to binge watch all of this. And of course, I'm also sharing my own trade. So for example, here is a trade opened on the 30th of April. And here's then how I closed this 5 days later. Yes, this is only a single example, but that's why I showed the overall portfolio chart before, right? This one over here. And so feel free to check it out. It's currently $125 per month. It used to be 165 when everybody was super hyped about crypto. Currently, the attention on crypto is rather low, and so the price is also lower. If you lock in that price now, you will not be affected by the price increase that might happen once the market picks up again. So everybody that signs up locks in their current rate. If it's your first time here, feel free to subscribe. I publish here regularly. Like would be very much appreciated as well. It helps the channel grow. See you next time on YouTube or see you in Premium. There should be somewhere a card over here. You can just click on that and it will lead you directly to the sign up page. So see you over there as well. Cheers.